This is Richard Flax at Moneyfarm with a regular monthly market update. After some positive performance over the summer, September saw a return to volatility in markets, with no asset class being able to generate positive returns over the month. There have been a few reasons for this turbulence. We've seen the conflict in Ukraine continue, and in some cases, rhetoric escalating. We've seen significant pressure in UK financial markets over the past couple of weeks in the wake of the so-called mini-budget, which sent the value of the pound down relative to the dollar and significant volatility in fixed income. The Bank of England was forced to step in to try and stabilise the fixed income market, and even if we've seen something of a U-turn from the current government, it seems clear that policy making will be a significant driver of volatility and market concerns going forward. The key concern for global markets, however, at least in our view, continues to be around inflation, and specifically its impact on central bank policy. We saw higher than expected inflation in the US reported for the month of August, and that prompted a further rise in market expectations for interest rates. We also saw a new set of economic forecasts from the US Central Bank, indicating higher inflation and slower growth over the coming years than it had previously expected. In the Eurozone, we continue to see weak economic growth and high inflation, to some extent driven by tensions around the energy price, while in the US, we see price rises to a large extent still being driven by strong demand and a fairly robust labour market. Despite all of that, we do see signs that slower growth could begin to feed into slower inflation. Things like container freight rates, commodity prices, and manufacturing new order surveys have all fallen in recent months. We do think we'll be in a situation where negative economic news, to the extent that it impacts central bank policy, may be taken positively by financial markets. So what implications does this have for Moneyfarm portfolios? There are a few points worth making. First, we do think that inflation will begin to decelerate in the coming months, and that could provide a catalyst for a recovery in some financial markets. We think that the US is probably best positioned to exit this complex periods, with fewer energy concerns than in Europe, and with an economy that still remains relatively robust. Overall, from a short-term perspective, we maintain a cautious positioning in terms of our absolute equity exposure. The trade-off here is really between cheaper valuations and earnings expectations that we think need to come down a little bit more to encompass the slower economic environment that we expect to see. But from a longer-term perspective, starting valuations do look significantly better than they have done over the past couple of years. On the fixed income side, it's a similar story. Rising government bond yields mean that you can earn much more of a return in fixed income than you could in the last few years. We continue to maintain a relatively cautious positioning in terms of favouring short-term government bonds, but we are looking for opportunities to extend the duration of our fixed income exposure. If there's anything that you'd like to discuss about financial markets or about your portfolios, our investment consultant team would be very happy to speak to you. Otherwise, thank you for listening and look forward to speaking to you again soon.